Welcome back. In this video, I want to talk about how dividends are taxed here in Canada. I'm going to be talking about two different types of dividends: Canadian dividends from Canadian companies and foreign dividends, which are dividends that are not from Canadian companies. They are taxed in very different ways, and we'll talk about each of them. We're going to start talking about how dividends are taxed in a non-registered account. These are the most complicated, and there are some tax benefits for certain types of dividends, so I thought we would start there. First, the easy one: foreign dividends in a non-registered account. There are no tax advantages. Any dividend you get from a foreign company gets taxed at your marginal rate. So for example, if I received $10,000 in foreign dividends in my non-registered account, I am in the 30.5% tax bracket. I would get taxed 30.5% of that $10,000, so I would lose $3,050. Now, what about Canadian dividends? Well, that depends. So there are two types of dividends coming from Canadian companies, and I'll use this table on taxtips.ca to show you the two different types. And you can see here that there's eligible Canadian dividends and there's non-eligible Canadian dividends. You can see they are taxed differently. Basically, eligible Canadian dividends are dividends coming from large Canadian companies. Think your banks, your RBCs, your TDs, and your oil companies, Canadian Natural Resources, and all that sort of stuff. The reason you get these tax advantages here is that the companies have already been taxed in Canada, and when they give you that money as a dividend, then to avoid the double taxation, you receive the tax credit. And your non-eligible Canadian dividends are just dividends from smaller companies. A smaller company in Canada does have some tax advantages, so they get taxed less than a large company here in Canada, and so the tax credit you receive is smaller if you invest in a non-eligible Canadian dividend company. For the most part, I am going to be talking about eligible Canadian dividends, as that's what most of us are investing in. And you can see if you make less than $154,259 in Alberta, I am in Alberta, so I'll just use the Alberta table here, then dividends get taxed at a lower rate than capital gains. One thing to be aware of, though, is that dividends will get taxed every year, whereas capital gains will only get taxed when you sell your investment. So if I held, say, an RBC stock, then every year the dividends will get taxed when I'm filing my taxes, but I won't get taxed as for the capital gain until I sell some shares of RBC. And you can see that if you make under $58,523 here in Alberta, you actually get taxed back from your dividends, which is really nice. Now, there are some things to be aware of. How the taxes on the dividend, or how the dividend tax credit works, can have implications on other things as well. So here I've got an example. So I am in the 30.5% tax bracket. The dividend tax credit, there's two parts. There's the federal and the provincial, and the federal portion is 15%, just over 15%. And here in Alberta, it's just over 8%. Now, how does the taxes get calculated? So let's say again, hypothetically, I receive $10,000 in eligible Canadian dividends. So let's say I have some XIC in my non-registered account and I get $10,000 over the year in dividends. To calculate how much tax gets paid on that, there is a gross up. And you can see here, it's 38%. So my $10,000 that I earned in dividends actually gets grossed up to $13,800. There's a tax on that $13,800, not the $10,000, but the $13,800. And 30.5% of the $13,800 is $4,209. Your tax credit is based off of that new gross up tax, the $4,209. So I would receive, so 15% of the $4,209 is $2,072.73. And the Alberta tax credit is $1,120.56. So what happens is I take that gross up tax and I subtract the tax credits, and the total tax I pay is $1,015.71 on those dividends, which ends up being 10.16%. And you can see here on taxtips.ca, that's where that 10.16% comes from. Now there's some implications to that though. Because of that gross up, your salary is seen higher by the Canadian government. So I have two boys, so I collect the CCB, the Canadian Child Benefit, and the higher my income is, the lower my CCB is every year. And so you can see that by this gross up of an extra $3,800 from $10,000 to $13,800, my income is seen as $3,800 higher than it was, so I lose $216.60 on my Canadian Child Benefit. So you can see if I include the loss from the CCB with the tax, I'm actually paying about 12.32% rather than the 10.16%. 12.32% is still good. And you can see on taxtips.ca that capital gains would get taxed at 15.25% for me. And so it's still worth it for me to get those dividends there. Again, taxed every year rather than on the sale though. So there are implications there as well. There are a few other things that are income tested. So the big one is OAS. So if you are collecting OAS and you're in between $95,323 and $154,708 in 2026, then you could be subject to the OAS clawback or the recovery tax. And you can see that you would lose $570 for that extra $13,800 gross up. Your average tax would be 15.86%, and now capital gains are taxed lower than the dividends if you are subject to the OAS clawback. There are other programs that are affected by this as well. GIS, if you're collecting GIS, this is a big one. The age amount tax credit if you're retired and 65 or older. The GST and the HST credit. The new grocery program set by the federal government. So anything that is based on your income will be affected by this gross up as well. So be aware of that. So where do I invest all my different ETFs? Again, I don't use an all-in-one asset allocation ETF. I do recommend it for everybody. It is super easy. I try to make my portfolio as tax efficient as possible. So my portfolio is a little more complicated than if I had just done the asset allocation ETF, but it does allow me to save on some of these taxes as well. And so I'll show you what I do here. So you can see here, these are the three ETFs that I generally invest in: XIC for my Canadian portion, XEF for my international portion, XUS for my US portion, and VTI for a US portion as well. That's in USD currency. I'm in no way recommending these ETFs. It's just what I happen to use. So in a non-registered account, XIC has that tax credit we just talked about, and the others just get taxed at your marginal rate. So I would be taxed at 30.5% for any of those foreign dividends. If you held those four ETFs in an RRSP, then XIC, your Canadian portion, there's no taxes until you start withdrawing your RRSP or your RIF income, and it's taxed as income when you do that. And generally you retire in a lower tax bracket than you are in your working years. Your XEF and your XUS, those are Canadian currency ETFs. They are subject to foreign withholding taxes. XUS is 15% foreign withholding tax, and XEF, depending on the country that's held within it, and it holds a whole bunch of countries, so it varies between 10 and 15%. And then when you retire, the rest of it gets taxed as income as well. And the big advantage there for the VTI, if you hold VTI in your RRSP, Canada has a treaty with the US, and that has 0% tax. And in your TFSA, XIC has 0 tax. That's wonderful. And the others are subject to the foreign withholding taxes. And so hypothetically, you receive $1,000 as a dividend in a non-registered XIC. You'd only be subject to $16.90 in tax because of the tax credit. And that's if you're in the 30.5% tax bracket like I am. And you can see XEF, XUS, and VTI are all subject to the marginal tax bracket, so $305. So huge advantage for keeping your Canadian investments in your non-registered. Your RRSPs, Canadian dividends, right now as you're investing before retirement, $0 for the XIC, $110-ish for XEF, depending, again, it's in between 10 and 15%, $150 for XUS, and no taxes for VTI. And then when you start withdrawing, let's say you can retire in the 22% tax bracket, then XIC, I mean, this was a rough calculation, is about $220. XEF, again, you had the $1,000, you lost the $110, so I just put a number in. I taxed 22% of the remainder, $890, and you had $195 and $187, depending on which ETF. And your TFSAs, subject to the foreign withholding taxes, $0 for XIC, 110-ish for XEF, 150 for XUS and VTI. So this is what I do. These are not my numbers at all. I just threw in some examples here. So I do have my TFSA, my RRSP maxed out, so I'm investing my non-registered account. And let's just say that I have $200,000 in my TFSA, $200,000 in my RRSP. My RRSP is a lot lower than most people because of my defined benefit plan, so I don't have very much that I can put into my RRSPs. And then the rest, I have $100,000 into my non-registered for a total portfolio of, say, $500,000. So what do? VTI goes into my RRSP. So 100% of my RRSP is in VTI so that I save all those taxes, again, 0% tax. And from that $500,000, I split my portfolio up into 50% into my US holdings, 25% in my Canadian holdings, and 25% in my international holdings. And you can see that would be about $250,000 for the US portion. So I max out my RRSP with VTI. Again, 0% tax on dividends if you put VTI into your RRSP. The rest I just put into my TFSA. So that would leave $50,000 in of ex-US. I don't do the currency conversion. There's no advantage there. So you might as well leave it in Canadian currency. For my Canadian portion, I put everything that I can that's left after my maxing out my TFSA and RRSP into my non-registered to take advantage of that tax benefit. And so in this case, it was $100,000. The rest I put into TFSAs, and you can see I just put my XEF into my TFSAs. So really I use my TFSAs as my balancing, and I use my non-registered for my Canadian portion and my RRSPs for my US portion in USD. That's just something that I do to save myself as much tax as possible. Again, it's probably a lot easier if you just hold an asset allocation ETF and fill it up evenly. But again, I like to try to maximize every dollar that I can. Hope this video has shown you how dividends are taxed and how to distribute your ETFs or stocks in a tax efficient manner. If you've enjoyed this video, please like and subscribe. Have a wonderful day.